Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our special guest this week is Adrian Mastracci from KCM Wealth Management in Vancouver. Adrian, just before the break, you mentioned bonds. A lot of people have been paying a lot of attention to bonds. It's surprising how much of the headlines in the financial papers they've occupied over the summer of 2010. First of all, what's happened to bonds since June, July, August this year?
Well, I think bonds are certainly the safe harbor, shall we say, for a number of people. There are so many people out there that want the capital back, not necessarily the return on the capital, but the return of the capital.
Yeah, right.
And that being the case, then they're prepared to take sort of low returns in the bond area. And just to give you an indication, the 10-year bond area for the U.S. back in April of this year was 4%.
Okay.
Today, at least in the very recent past, it's been 2.5%, 2.6%, 2.7%. So it's come down a fair amount just since last April.
Now, there's an inverse relationship, isn't there? The more popular bonds become, the less they pay. Isn't that the case?
That's right. And their price goes up as the interest rates comes down. So people have made a pretty good level of return on the capital in bonds. But certainly, going forward, going from here on, nobody really knows where those bonds are going to go. They could be stagnant, in which case you would only make, let's say, on a 10-year basis, 2.75 or something like that. But you certainly have to look at it and say to yourself, am I prepared to take the small return because I can't stand the risk? If the answer is yes, then you're in.
What's the difference between a Canada savings bond and a U.S. Treasury bond, or are they identical?
Well, it all depends on how you view the credit worthiness of the U.S. versus Canada.
Oh, okay.
And if you think that they're in the U.S., certainly they would be as high as you're going to get. In Canada, it's as high as you're going to get. And you get a very small amount of return on both of them, whether it's the U.S. or the Canadian version of the bonds.
What about private sector bonds? The banks issue bonds. Some of the major corporations in the marketplace issue bonds by way of raising money for their adventures. Are they riskier than government bonds? Do they pay better?
Well, the way it works is the federal government is the highest credit rating. Then you've got the provinces in Canada, or the states, the individual states in the U.S.
Okay.
Then you've got a number of corporations who issue bonds. Then you've got municipalities that also issue bonds. So each and every one of those will be rated according to some set of statistics, given how much they spend and how much free capital they have and stuff like that.
This summer, the fly in the ointment turns out to be the U.S. Federal Reserve. Mr. Bernanke and company have decided to implement something called quantitative easing, which means basically they're printing tons and tons of new money in order to buy U.S. Treasury bonds. And from across the fence looking down, Adrian, it looks to me like that all that money that's literally coming out of the basement to buy debt seems to me to be simply prolonging the debt agony and, if anything, digging the debt hole deeper. Is that the case, or am I misreading this thing completely?
There's a lot to that. One of the things that I would like to see them do is to stop doing all that printing of the money. They have not used all of the stimulus dollars that they had. They've used about half of it. But what they're also buying, that is the U.S. Fed, they're buying all the stuff on the balance sheets of the banks that perhaps they didn't want or has a few little difficulties with it. So it is not pristine. So what the Fed is buying is something that is not exactly top-notch, but they are paying for it with top-notch dollars.
Yeah.
And that's one of the difficulties that they will have. And hopefully things will get better and they will be able to sell those off to someone down the road. But if they can't, then we're stuck.
How about the stock market as we wrap up our look back at the summer of 2010, my friend? How have equities performed over the last several months?
I would say a roller coaster is probably the best way to categorize them. They're sort of going up and down, sideways, no real direction. Just when you think you know that it's going in one direction, it goes the other direction. So it's just been one of those sideways things, and traders probably love it. If you're a trader, if you've got the moxie, to be one of those, then you probably have made a few dollars here and there. Maybe you may have also incurred a few losses,
right.
But at the same time, you should have made a few dollars. But the average investor, the one who's in there for the longer term, probably hasn't made any money.
Is there any sector that has outperformed any others, or are they all on the same roller coaster ride?
Well, it depends on how you look at it. Gold has done reasonably well from, say, start to finish. But most sectors have had their day in the sun, but they also slide back here and there. So over a short period of time, you're going to get some sliding here and there. And I really don't pay that much attention to all the sectors because I'm more of a total portfolio kind of manager.
Sure. And that brings me to my last question. The fee-only approach to being a portfolio manager. Why?
Because I can look at the client square in the face and say, you are paying my entire fee. I don't get paid from trailers or anything else. And if the client is willing to pay that, then I am working for that client, and I can look them square in the face and say, your best interest is what I'm looking for.
And you're not going to beat them up for trades and activity because you can make more commissions. You operate like a lawyer or an accountant.
That's right.
Or here's the deal.
I don't get anything from the commissions that are paid. So for buying something, the commission paid goes to the other side.
Adrian Mastracci has been our guest on the Money and Wealth Show this week. Adrian is a prolific newsletter writer, and you can find his work at kcmwealth.com. Adrian, thanks so much. It's great to see you again, and we appreciate your taking a look back with us at the summer of 2010.
Thank you, Sterling.
We'll be right back.
Good afternoon. My name is Larry Ray. I'm the chairman and CEO of Molycorp Gold Corp. As the name states, we do have a deposit we're developing in British Columbia, which is a pure molybdenum deposit. But our focus these days is on magnesium in Nevada. Through serendipity, we discovered a large deposit of magnesium running about 10% with a high purity and consists of about 256 million tonnes at this time, 52 billion pounds. Our main emphasis is to move this project forward by beginning a drill program later this year in which we can increase the integrity of the resources into the indicated and inferred, as well as increase the resource itself. For further information, please visit our website at molycorp.com or phone us at 604-531-9639.
Tax Tips with David Ingram.
You got a place down in Phoenix, or you got a place in Palm Springs or Cape Coral, Florida. You rent it out. You have to do a tax return, but I want you to know this, that the plane fare down to look at your rental property is not a tax deduction. And make sure when you're down there that you don't do any work if it's a rental property. You can't paint, decorate, or something. INS will come along and throw you in jail. That's a tax tip.
And that's our program for this week. Our thanks to David Ingram and to our special guest, Adrian Mastracci. And thank you for joining us. If you have some thoughts about today's show that you'd like to share with us, please send them along to comments@themoneyandwealthshow.com. I'm Sterling Fox. See you next time.
It's all about money. At the HowStreet.com Money Expo in Kamloops and Kelowna, see Garth Turner, Michael Levy, Ross Clark, David Smith, and Doug Casey. To attend free, pre-register now at HOWEstreet.com or register at the door.
Comments made on the preceding paid commercial program are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time.